Hi, I'm Darren Long from Delta Harbour on this week's Hard Money podcast. What to do with interest rates? They're much higher. They're going much higher. And add to all of this, the fears of inflation. We are in the throes of a major change in the marketplace. Let's break it down this week on the show. Let's talk about how gold and silver fit into all of this. And let's get you some gold and silver from Delta Harbour Assets. Stay tuned.
There are no shortcuts to building wealth today. It takes time, effort, sacrifice, and diversification. But today, diversification means something different than it did in the past. You deserve a more secure way to protect and grow your wealth. At Delta Harbour, we take this to heart. Our mission is to help by inviting you to add physical gold and silver to your wealth strategy. Book a free consultation today and let us show you how to protect and grow your wealth through the ownership of physical gold and silver. Let us show you the Delta difference. Hey, welcome everybody. Hard Money Podcast is back upon you. Good to have you here. You'll want to reach out to Darren Long and the team anytime. DeltaHarbor.com, Delta Harbour with the U. And that's the way you do it. We're going to talk some gold and silver here in just a bit, but I want to make sure you got that. And the number down, 1-877-323-GOLD, 1-877-323-GOLD. And other than this particular forum, if you want to go to LinkedIn and Instagram and Facebook and Twitter and everything else, simply Delta Harbour with the U. So let's get it started on this week's show, Darren. No doubt for sure this needs discussion. Inflation report comes out and it's a absolute whopper. Have not seen these levels in 30 years. People are freaking out. Want to talk about inflation, but get us caught up first with gold and silver, pal. What's happening there?
Well, again, John, in the week, we had a decent week so far. We're taping on Wednesday, and ultimately both gold and silver are range bound again over the last couple of days. Gold did reach higher early in the week coming out of the Sunday night open in Asia. But now holds in the 1960 range, 1950 to 1960 range, where silver is presenting with a slight better opportunity for buying in the lower of its weekly range, down in the 25-20. And I will say, John, for sure, we have a lot to unpack on this show today, but we expect both silver and gold to continue higher. It is coming. We expect both metals to go significantly higher over the course of the remainder of this year. And we do so on the expectation that we are going to continue to see much more geopolitical uncertainty, that we're going to see interest rates continue to rise, and that what we're going to discuss today in the inflationary pressures around the world, they are not going to let up anytime soon. It will be well into 2023 before we see any relief in inflation. And so this is a very important time, because this is kind of like the event that drives the change of the market. And if you were to picture a clock, 12 o'clock being the high of the market, stocks, bonds, cash markets, they're going towards 1 o'clock, while metals are down at the 7 going to 8 o'clock. So this is an exciting time, and we want to make sure that we have a little bit of everything in our portfolio, which we'll talk about on today's show.
Well, you did. You mentioned interest rates in your opening piece there, and Bank of Canada raising not quarter, not 25 points, but 50 points is what it ended up being, and people's mouths kind of dropped a little bit. Got to have an impact on inflationary pressure for sure. This week, the inflation report, and bam, the highest since 1991. That's the year after you and I left high school. So it's been a while, but people are kind of freaking out, right?
Well, it is, and for good reason, John, because we're now seeing transitionary phase occur in the marketplace, and many analysts say many different things, but numbers don't lie. Consumer price inflation accelerated to 6.7% year on year in March, up from 5.7 in February, and that was well above the consensus, which was around 6.1% in the highest rate, as you indicated, since 1991. Easy credit conditions are being rapidly reversed right now, and then some, with interest rate hikes on the horizon. In this report, in particular, it's important to note energy price growth accelerated to 27.8% from 24.1% in February. And we saw gasoline price growth hit 39.8% year on year, up from 32.3% in February. So even that's continuing to get higher. Food price inflation also moved higher to 7.7% from 7.4%. and it was the highest in over a decade. So as you go out to those local Sobeys and those local Zehrs and those local places that you love to go and shop, no frills everywhere, you will notice, A, the shelves have less on them, and B, the prices are much higher. That trend is going to continue. It's going to eat away at your capital, eat away at your disposable income. And since we know the Bank of Canada was late on inflation, they're going to use a lot more firepower to deal with it. So we expect that there's going to be quite uptick in interest rate hikes, another half point coming shortly, which we'll discuss. And I suspect throughout the remainder of this year, up to 6 more interest rate hikes, which means by summer, we're looking at 5% mortgages. No problem.
Yeah, for sure. People get prepared for it. Sometimes the reports show modest growth in parts and areas measured like durable goods or even services, but it appears not the case, right? This is a huge uptick across the board here with wide-reaching outcomes to be expected, no?
I do think that we are going to see wide-reaching, higher impact outcomes. The acceleration in price growth was not just food and the energy story. If you exclude those categories, inflation was up 4.6%, which is still well above the benchmark rate, because in February is only 3.9%. Prices for durable goods were particularly strong. They were up 7.3% year on year in March, which is to say, if you take that data and stretch it apart, cars, furniture, and things related to those two things were up the most. And that's supply chain issues, John, as we've discussed on this very podcast. Higher input costs, which contributed to these increases. And in addition to that, not only were durable goods higher, but also service rates were higher as well. They accelerated up 4.3% year on year versus 3.8% in February. And, as health restrictions across the country continue to ease, higher prices for close contact services are going to contribute to those gains. I expect these to rise again next month.
Again, reaching out to Darren and his team anytime beyond watching this podcast, 1-877-323-GOLD. Really simple, right? To make that phone call, we'll discuss in just a little bit how to get that part of your portfolio up and running. It's exciting. It's a good time to do it too. But with this data in mind, Darren, what are the key implications moving forward here, do you think, with what you just said?
Well, first thing is inflation was expected to be hot in March. We all expected it to be hot in March, but it was even hotter than expected. So it's no surprise to anyone who has filled up their tanks in March that higher gasoline prices drove an outsized gain in consumer prices. In part due to the war in Ukraine, the forecast for oil prices is going to be more uncertain than usual for sure. And then there are pricing pressures across other areas of the economy, which are showing more heat, both for goods and services. I would say that inflation is likely to remain well above the Bank of Canada's target range until, as I said earlier in the show, 2023 at least, if not longer, which will take consumer spending down, as well as consumer purchasing power. And interest rates are going to go higher. I mean, the Bank of Canada has already responded by taking 25 basis points earlier in the year and now 50 basis points last week. Again, we expect that to happen next month as well. And that's the case. That's the story. That's what everybody's discussing. And this is the right time, as far as I'm concerned, to make adjustments to your wealth, to strengthen your approach, and to increase your diversity, really overall, is what we're looking for our clients to consider. And I think, John, wholeheartedly that gold and silver should be well a part of that diversity. And there are very, very key historical moments in which the threat of inflation over long periods of time has sent gold and silver climbing astronomically higher. So this is the point in time where we start taking stock, where we dive into our wealth, and where we start to add assets like gold and silver.
Well, I mean, mortgage rates, mortgage interest rates, and that type of thing, for sure, certainly going to result in increases for sure, as you said yourself last week, and the lower housing prices trending coming in the coming months, you think, or that's just going to keep going crazy?
Well, I mean, there with housing and real estate, the ground shifting for sure.
Mm-hmm.
As we know, on Wednesday of last week, the central bank jacked its key rate a half point, and in one stroke, they doubled the rate. I mean, if they can do that, it's pretty easy to see that a slowing in the housing sector is coming. Financial markets are pricing in at least 4 more if not maybe as much as 6 additional increases to take place by Christmas. Mortgage rates have doubled since the 2022 start, January 1st. And I would guess they'll be in the 5% range by summer of this year. This has happened at the same time as we've seen our politicians, which we'll call come from behind politicians, because really they're late to respond, really late to respond. They're going to slap new taxes, restrictions, constraints on real estate. And we talked about some last week, the banning of non-residents to vacancy taxes, flipping rules, assignment penalties, and really just cutting down on out-of-province owners. And this is a lethal brew. It's too little too late, and they're going to do it all at once. So if you look across at the banks and what they're saying, and again, we always follow the banks. The banks know they have the inside track. No matter what anybody believes, we do not bet against the banks for now. And if you look even at RBC, they're saying shockingly that they're predicting there could be an absolute year-over-year price decline in Toronto and Vancouver within the next couple of months. Duh. I mean, we already see it, but when banks start saying it, it means they're acknowledging it. And, if we look since the beginning of the year, even at the 416, John, 7% down. So for people who bought a month ago, they spent about $150,000 too much on the average price of a home in Toronto. So already it's dropping, and we're seeing that happen, and it's not going to change.
Yeah, I mean, you go beyond there, Toronto, Vancouver, regionally, provincially, doesn't matter. Just it's a worldwide phenomenon. You just have to look south of the border, right? I mean, they're experiencing the same thing.
It's true. If we look at their inflation rate, it was even worse, 8.5% last week. I mean, let's not beat around the bush here. To announce a 6.7% inflation rate in Canada does not take into consideration what the street level is, what it costs in your local community to buy that, bit of food, or that loaf of bread, or those eggs, or that cheese, or the steak, or put gas in your car. Every community is different. So you can definitely bet on the actual street level inflation rates in both Canada and US being far closer to 10% than they ever have. In the US, I'll tell you right now, the inflation rate is over 10%. So what does this mean? Well, it means, number one, inflation's out of control. In part thanks to Putin, thanks to higher oil prices, the supply chain problems coming out of Shanghai, and in delivery with Chinese products, obviously, full employment, full unemployment. I mean, we haven't been able to maintain a lot of full employment in a number of different regions around the world. And then we have, post-viral consumer spending. It was pent up, and of course everybody announced the end of COVID, which it's not, but people feel like it is. Mentality is, let's just get out of this, stop wearing masks and get out there. But it suggests that the US Fed are also going to hike another 0.5 point at least next month, and then throughout the duration of the year 6 more times as well. And around the world, the same thing. World residential real estate exploded during the pandemic's cheap rate environment, and during all this viral cocooning that we did, where we just work from home. Canada was not unique in that. And what does make us different though, is that Canada experienced a tremendous uptick in the premiums we're paying in relation to our income. And in Canada, I think that you're going to find, at least in the G20, we had the worst case of this happening, in which we were paying a much, much higher premium based on our income than any other G20 country was. And that has, had people overstretched, and they used credit to buy that. They unlocked all the HELOCs, the home equity line of credit. Yeah. And now it's added up to about 1.7 trillion in mortgage debt. And this makes families here very vulnerable right now, John, to a sharp price correction and negative equity. Remember, if you laid down 7%, you somehow finagled your way into a lender and laid down only 7% on a house, and the house value lost 7%, you have zero equity in that house now, right? And if it goes down 8%, you've now lost 1% of equity. You're in negative equity. Well, what happens in negative equity? Foreclosure. It's the worst word in the world. So those that are speculating, those that are using their existing equity to speculate, stop. It's a terrible thing to do. You shouldn't be doing it at the top of a market, and you will be the last in and the first out, because you will suffer from a tremendous correction in the housing sector, which is coming. And as rates rise, Economists say it's going to cut the borrowing power of new buyers by about at least a quarter over the next year or so. And it means right now, John, the spring market has not sprung. It's dead. It's dead. It's over. And it ended in the first week of March as soon as those rates started rising.
Kind of sounds like the focus has kind of changed for people. Wouldn't you agree?
Well, I think it's totally changing. I mean, listen, the return to work, it's happening, right? We see it. Just look at your traffic in your drive down to work every day now. It's rising. It's getting bigger. Spring is trying to open up, and we had snow this week, mind you, but still, I mean, we're trying. People are focused on the warm weather coming and flowers and gardening. Kids are back to school, all in there. Everybody wants to be part of something now. You don't want to get out and experience it. Let's go to the Jays home opener. Let's go down to a Leafs game. Let's go to the Raptors game. We all want to get out now, and after being cooped up in our houses, we want to get out of here. We want to travel. We want to do things. And that doesn't mean we want to go to the near north. So expect there to be a drop in cottage demand. Expect there to be a drop in the value of cottages, period. Again, another side effect of higher interest rates and people coming out of this drastic pandemic. And one of our clients even, and this has been something we've discussed a lot, I don't know for those of you that know, but downtown Toronto has something called The Path, which is around 30 kilometers of underground tunnels that are full of shops and services. And one of our clients this week was just talking about the fact that he can't believe there's so much life now. It was nothing just a few months ago in the depths of winter, dead, because people were afraid to go out. COVID was so rampant and people just weren't sure, that they just stopped going. And so many businesses shut down, and The Path is host to about, I think, give or take around $5 billion worth of business per year, something like that. And again, it went almost to nothing during the height of this pandemic. And so now this client is saying it's amazing because he's going down every morning, grabbing a bite to eat, and he's seeing buskers back to work. He's seeing people coming through and everywhere. And we're seeing and hearing from our clients that buildings are being filled again. Businesses are going back to work. And yes, there's a lot of people still working from home. That's not going to change. That hybrid model is going to be the model going forward. But a lot of employers now want their employees back to work, and they're going to demand as that grows as well. COVID may not be gone, John, but it's gone enough. The masks are coming off. The sheen of this crisis has dulled. And we're being reminded that there's more to life than hunkering down in your home and working from home and just, staying in that closed section of your world so that you can prevent yourself from getting this, what is not as harmful as it once was, virus. So ultimately, yeah, we're looking at this, and we're on the other side of the mountain now. And we think people have to understand that this fear of missing out is evaporating in the real estate market. Interest rates are going higher, which impacts the stock market. Stock market starts to falter. Recession sets in. Supply chain issues continue. We may get stagflation, as we said, going forward. You have to think about changing the way you approach your wealth. And ultimately, how do you do that? Well, you take 10 minutes just to connect with people like Delta Harbour to discuss adding assets like gold and silver, which have a track record, a history of performing through these environments. Look back to post 2008. The next 36 months saw some of the largest gains for silver and gold that we've seen since 2000. Look back to the 70s when we saw the threat of inflation coming, when interest rates started to rise, when mortgage rates were in double-digit territory, when bank savings accounts were making 13, 14%. That's when gold and silver were shining and people were flocking to them. Historically, that's what happens, and that's about to occur now. So this is the time we want to get gold and silver into our wealth strategies.
That discussion's coming up here shortly. And in the meantime, 1-877-323-GOLD, right, is how you reach Darren and the rest of his team. So knowing that all of that, seeing what you see on the ground, there's still some Canadians, there's still quite a few, regardless, have earmarked some dollars to invest in real estate. Again, maybe a bit of FOMO. I don't know. But what would you suggest and what would you say to them?
Well, take into consideration what the Bank of Canada has at its disposal in terms of being able to effectively offer some type of tool to deal with problems like recession. they only have their only real instrument is a very blunt one, and that's the cost of money to effectively alter that up or down. And by raising it, the cost of money, they try to strangle demand for borrowing. So obviously that's what they're going to do, slow expansion in debt and cool off economic expansion. Well, they believe directly that inflation is expansion. I mean, that's what it's equating to. May not be, in which case why we make the argument that we're going to see stagflation rather than just pure inflation.
Right.
And usually it works, but not fast. I mean, it takes time once you're raising rates to do so. They did it in the US in the early 2000s, and you saw that boom take 8 years to develop from 2001 basically 2009 into the crash, and interest rates in the US and Canada went up near double digits. And that's going to be the case again here. We're going to see that happen. The Bank of Canada has a target rate of inflation around 2%, and we're running at 3 times that, more than 3 times that. So rates will therefore continue to rise through, I guess, the end of this year and certainly through next year for sure. But I think into 2024 myself, to be honest with you, they win or there's a recession. And I think we see recession before they win. In the meantime, as you know, the Bank of Canada rate doubled last week from 0.5% to 1%, which is the largest single jump in 22% in 22 years. And it's likely going to increase again June 1st, July 13th, September 7th, October 26th, and December 7th. And by Christmas, the benchmark rate we expect will be at 2.25% to 3%, somewhere in that range, the benchmark, which means we base everything else on there. The prime rate probably at the big 6 banks will thus be around, give or take, 4 to 5.5% on lending with a 5 handle on longer term mortgages. And the implications for the housing market are wide ranging, John. And we've talked about it ad nausea here on the show, but just remember this: if you buy speculatively in the next few months, you're making a huge mistake, in our opinion. That's all we're going to say about that. But if you got to own and you got to put a roof over your head, you have no choice. You have to buy that house. Make sure that if you are speculating, though, that it's a long-term hold. Inflation right now, 6.7% in Canada, much more higher unofficially than that. It's not crested, and it's likely not to retreat to lower standards for a few years. So basically, if you think about investing right now, John, an important point for those that are uncertain or that have cash in the bank or that are don't want to be risky, don't want to put their money into markets like cryptocurrencies or speculate on real estate. They have few choices, not too many. One of which is to have a GIC, right, or a high interest savings account. And you're losing purchasing power in those accounts. There's no two ways about it. Yeah. Your money is going to devalue. You're going to be at a loss in those types of accounts. When you lock it away, you have to do that, and you have to think about what performs well during these periods of times, during uncertain economic stability. Gold and silver. I mean, right there. Remind yourself about the 70s, what happened around the early 2000s, around 2008 to 2011. I mean, gold from 2008 to 2011 went from 650 to 1920. Silver, nobody even cared about. It rose from $8.50 to $49 in 36 months. That's going to happen again, right? Also remember that when you're looking at GICs and things like that, you look at a 5-year GIC. GICs do not yield recurring interest. So in a non-registered account, that's something you have to pay tax on. And that's income not yet received, right? So that's also more losses. And interest is taxed as regular income, right, without the preferential treatment afforded to dividends or capital gains. Right. Further losses. So again, most of those risk-averse investments are going to lose you money. I'd say if you don't want to do anything, just keep your money in the bank, for Pete's sakes. But then again, you have an ability to at least examine ways to diversify your wealth. Rates are going up a lot. but it's unlikely there'll be a single year in which bank savings or GICs pace at the same rate as inflation. It's not going to happen. We're not going to see it this time around. Sorry, the 70s are gone. So there are better choices, especially for those who need their financial assets to pay them income. But, when we look at it here, we have to remember diversification is the key. Gold and silver have to be part of your portfolio in order to have true diversification. Whether it's 10, 15, 20, 30% of your net portfolio, it's up to you. Talk to the experts that you trust, talk to the accountants or planners or advisors in your life, and get them in touch with us. We'll talk to them about your wealth with your permission, and you can be part of that conversation. You can lead it. But remember, diversification is important here. And it, when it comes down to it, there's not going to be a big, huge hoorah about recession. It's just going to happen, and you'll be the last to know about it. You'll just read about it. So be prepared. And then, of course, with this environment, stop speculating on houses. Real estate markets are not going to double from here. You're going to start buying at 1.5, 1.6, and you're selling at 1.3, 1.4. If you think you're going to get that short-term gain, forget it. And in addition to that, rental rates, they're going to drop because there's going to be more houses available and less demand for buying. So there's going to be more houses to rent. And again, that's something we want to put into every discussion on wealth, John.
And that the landing pad really is getting into some physical gold and silver. That's generally why we're here, as well as updates every week. But having said that, pal, what are the best ways for people who have not dipped a toe in yet to get in the market with you guys and start buying?
Well, first off, take a trip over to the website, deltaharbor.com, and take a look at your options. We spend a great deal of time trying to educate our clients. Set up a phone call. What is 20 to 30 minutes out of your life in the grand scheme of things for something that might last you 20 to 30 years? Yeah. And those might be returns that you cannot afford to live without, because this is what gold and silver does. People don't realize this, but that's the first step. Once you're there, you'll have the option to just simply buy online and take it home. If you just want to buy a few ounces of silver or gold, put something together for you, you can give us a call and we'll set up a direct purchase. We'll ship it to you. And once it's been purchased, you'll pay for it. And those products will be insured and sent with tracking information right directly to your home. In addition to that, storage. Why do we like storage? It's safe. It's liquidity. It means you can buy and sell on a phone call. It's cheap, relatively speaking, compared to what insurance is going to cost you at home. House insurance does not cover bullion. You need a separate plan for this, which is going to be way more expensive than putting it at a storage vault with Delta Harbour. So we have that option available. It's insured. It's segregated. It is in your name. It comes with your bar information, inventory reports, and you can visit your product. That's the best of all. You can come down to the vault and visit your product anytime you want. You have another option, though. If you're on our site, take a look at the bulk bullion option. For those that just want exposure to silver and gold, this could be the best way that you could put money into these markets. Exposure to silver and gold can come without the high premiums now in the marketplace. Some people, they want their gold and silver on them. They want to own it. They want specific bars. They want serial numbers. They want all that stuff. Mm-hmm. But for people that just want exposure to physical gold and silver, bulk bullion is the best way of all, because you don't have those high premiums. They're removed. And better than that, you can, with your choice, it's not an obligation, you can finance up to 80% of your purchase. So you could lay down that 10 or 20,000 worth of silver. You have physical bars there. They can be used as collateral to gain up to 80% more product in gold or silver. So you have the option with bulk bullion to do that, keep your premiums very low. That's an exciting option, which I highly encourage people to look at. And then at any time, if you want to convert to coins or bars, 100 ounce, 10 ounce, 1 ounce, whatever you want, you can pay the premiums then at that time, even use your profit to do it. And so this is a very, very affordable and very smart way to do, to take some ownership of gold and silver here at Delta Harbour. And then last and certainly not least, the registered accounts. We can put bullion into TFSAs, RSPs, lifts, RIFs, liras, pensions, and all that. And you can bring it over from an existing facility. So if you're with another big bank, or you're with another credit union, or you have a combination of the both, we can bring some or all of that over to Delta Harbour. We have a partner in Questrade, and be able to put silver and gold in your portfolio. So those are the options, John, and it all starts with a trip over the website or a phone call using the number you've given out today. And we would be delighted to spend time getting to know this client, getting to know all the ins and outs of their wealth, and to put together a package for them that hopefully will offer them diversification and have some fun. Bring fun back to money. It shouldn't be stressful. Let's, instead of speculating in the wrong places, let's focus on the right places and what the next 4 or 5 years are going to bring for gold and silver. I'm so happy and excited, and our clients are so happy and excited. I'm not sure there's going to be a better place to park your money.
Well said, brother, for another week. And again, it is so simple just to reach out. If you didn't learn enough here today on this edition of Hard Money, just reach out. As Darren said, the phone call, 1-877-323-GOLD, 1-877-323-GOLD, of course, deltaharbor.com. Same goes for youtube.com/Delta Harbor, and also Instagram, Facebook, Twitter. It is all Delta Harbor with the U. We'll catch you next time on this podcast, Hard Money, right here with Delta Harbor.